Hello guys, we're going to have a very quick download on Silicon Valley Bank and Silvergate and Signature and all that. Right? So what's happening here? What's happening here is a classic bank run. And so classic bank run happens when people are worried about their deposits and they take money from the bank. Right? Why does it happen? Lots of times there's a mismatch between your deposits and whom you have lent to. People have put money in you and whom you have lent to. Right? So before diving deep into Silicon Valley Bank, and I'm not going to dive too deep, before going into that, I'm going to just have one quick round of discussion on what do banks do. And we all know this. We put money and they lend out money. Very simple. Right? So we put money in the bank, they lend out money from the bank. If they have 100 rupees of deposits, then they lend out maybe 70 rupees, keep some reserve. Right? Sometimes in the short term, they have 100 of deposit, they may be lending out 110, 120 and cover the gap, or they may be lending out 50, 60, cover the gap. And so where do banks make money? They make money because they collect deposits and pay say 4% interest. They give out loans and collect 7% interest. So that gap is where they make their money. Apart from transaction fee and all that, the banking element is that gap. And so that's how all banks work. Very simple. So they take deposits, they lend out. Why is the bank needed? The bank is needed to provide trust. Suppose you have say 10 lakhs with you and somebody else needs 10 lakhs for a loan. So it seems like the bank is practically taking 10 lakhs from you, giving it to that guy, giving you 5% return, taking 10% from him, making money. It's super important because if that guy fails, your 10 lakhs still gets money. That is the trust that the bank is bringing in because he's collected this 10 lakh from a million people, giving loans of 10 lakh to a million people. If some 3 guys go bust, your 10 lakhs is not directly dependent on one loan the bank is giving. And so when do bank runs happen? And bank runs happen because of kind of 2 categories of things. One is called a liquidity issue, other is a solvency issue. There is some rumor twirling about a bank being an issue, being in trouble. People go there, withdraw their money. So the bank had deposits of 100 and loans of 70. Banks generally have deposits that the claim is immediate, loans are longer term. 100 rupee deposits loaned out 70 rupees. Right? Nice and fine. People are not always going to come back and collect their money. This stays with me. I have short term, medium term, long term deposits. I'm fit. Suddenly some rumors swirl that this bank is in trouble. Some of their portfolio has gone bust. Then people come and keep withdrawing money. 100 goes to 90, I'm all right. 90 goes to 80, I'm all right. It goes to 70, I start sweating. Because after this, I may not have money in my system to disburse. So I'll raise money. I'll say, look, give me the money. I'll sell something. I'll borrow from the central bank. The central bank has to have that trust in me to say, hey, it's a short-term problem. Your business is sound, right? So, and therefore, you can survive. When is it a solvency issue? When I have taken 100 rupees in deposit, I've given 70 as loan. In that 70 rupee loan, 20 are to risky buggers. And not just risky buggers I know they are not going to give me the money. And that comes in many categories. One is I have lent it to some business which has gone into dicey territory, or some businessman who has a dicey reputation, or I have given it to my brother-in-law's cousin and it's coming back to me. So that can happen in several ways. Then there is a hole. You've taken deposit, you're giving out loans. Some of those loans are not coming today, they are never coming back. And that's an issue. And so whenever there is a solvency trouble, when the bank, there is an issue per se, because the two sides don't match. Which is why all banks are expected to maintain equity. What is equity? Who owns the bank? So they take deposits of 100, they give out loans and maintain their thing. The buffer is what is owned by the owners of the bank. That is the equity. So if things are going well, my reserves will keep on going, my equity will keep on growing. If things go badly, I've given a bad loan. I've given 70 rupees in loan, of which 5 goes bust. That 5 will reduce my equity buffer. The owner's thing will shrink, but the depositors are still safe. This is how the banking system works. And the banks provide the trust, they provide the intermediary role between deposit and lender. If it's a liquidity problem, then it's fine. Somewhere the central bank will say, look, I'll lend you money, your system seems to be fine. The bank will sell something, they'll handle it. If it's a solvency problem, that is fundamentally the business gets broken somewhere, then I'm in trouble. That's the thing I need to worry about. When does a solvency problem arise? When I have lent to the wrong buggers, who I know that big loan, 5,000 crore loan, bad debt, it's not going to come back. 25,000 crores lent to some airlines that's never going to come back. Those things happen, then you're in trouble as a bank. Then if the equity falls and falls and falls, at some point of time, the central banking authority, the RBI or the federal bank in the US, they'll come back and say, you need to raise equity, you need to have more of a buffer. So raise money, raise capital. Sometimes you're worried that the equity will go to zero. That's when a bigger problem comes. If the buffer goes to zero, then you have no way of sustaining and surviving. Now, what happened at the Silicon Valley Bank? They are the bankers for the tech sector, the venture capitalist and cool tech sector, which is a load of hogwash. And lots of these companies are beautiful, wonderfully run and do some meaningful thing. And then lots and lots more are just selling hot air for nothing. Right? So these guys have raised a lot of capital, had raised a lot of capital pre-pandemic and into the pandemic because interest rates was low, venture capitalists were flush with money. They thought they could do some revolutionary things and all that. Silicon Valley Bank was banking a lot with these guys, which is the tech guys, and a segment of it was crypto. I think Silvergate had more with crypto and Silicon Valley Bank had more tech. What happened when money was free? When this is the heyday of maybe 2016, 17, 18, 19, when the interest rate was low, venture capitalists were flush with money. All these guys who were running these startups, they were funded to the gills. And this is pre-2021, that was a scenario. Lots of money and funded to the gills. So Silicon Valley Bank had lots and lots of deposits, lots and lots of money. Their book, I think, grew 4x in 24 months. On my book, the number of deposit they had, amount of deposit they had, went, I think, somewhere in 40-50 billion to 180-190 billion, just flew. And so whenever one deposits increase, banks are generally happy. Their valuation increases. It's like the bank has grown in size, right? Which is nice. But it is not like revenues growing. It is like funds growing. So if I'm running a company, we have revenues for 2M, our revenues go 4x, I'm very happy. But if you're a bank, your deposits go 4x, you're very happy if you find good ways to deploy that. So they probably, Silicon Valley Bank called up all these guys and said, do you want loans? And those guys told them, look, we are flush with funds. I have a giant deposit with you. Why will I need loans? I have enough money. If you want more deposits, call me up. I'm not disbursing them right now. I can put it there. So what they did, they couldn't find suitable avenues to lend out. They had more and more exposure, therefore, to the government bond, the treasury. All good because the interest rate low environment, everybody is flush with funds, the total book is growing, things are fantastically fine. Until inflation ran its head and the problem became that the portfolio they held in treasury, that started crashing. That is, I have treasury bill exposure worth 100. When interest rate goes up, this 100 goes to 90, 85, 82, 81. And I'm going to have an environment of high interest rate. It keeps crashing more and more. If this crashes to a point where my equity buffer goes to zero, then I'm in trouble. Which is what has been happening now. It is not like they have lent to bad actors or they've lent to an industry that went sour. They don't have that kind of exposure. They have an exposure to probably the most reliable asset the US knows, which is the treasury bill. They have exposure to that. That is being marked down because interest rates are going up. And that markdown is eating into the equity. And therefore, if my equity goes to zero, then there's no reason for it to sustain. At one point of time, they had to raise capital. They had to raise money. So they sent a message out saying, hey, good be we're raising money. We're raising some $2.5 billion. Or we want to raise money. We're interested in raising money. The moment you say, look, I'm interested in raising money, then you're in trouble. Because if there's no compelling reason for you to expand, you're a growing bank, your book has grown 4x, why would you want to raise capital? That something is wrong. What happened with Silvergate is they had to liquidate parts of their portfolio to meet some obligations. And they liquidated at big losses. So one guy made losses, another guy had huge markdowns and had to raise capital. Both are big red flags. Therefore, the bank run started. So the moment there's a red flag in the system, I worry. First of all, I worry about, is this bank sustainable? Am I a shareholder? Then I worry about, look, I have my deposit sitting there. If this bugger says my ATM is not working, you can't withdraw cash today. We are doing a freeze, like how all of these crypto banks did. Freeze on withdrawals for 3 months, 6 months. If that happens, then my money is stuck there. I don't want my money to be stuck there. I'll go stand first in the queue, take my money. Whatever money I can take, I'll take. And once that happens, then it becomes a vicious cycle, the race to the end. And that seems to be happening. Right? So what did the US government did? US government basically said, look, And both of these are going to stop being operational. Silicon Valley Bank ceases to exist as a functioning bank, which means they're super clear about their language. They say, look, we will not be bailing this bank out. Sometimes banks get bailed out. Another guy coming in, putting some equity, putting some funds, taking big stake at low price, continuing it as a sustainable business, and making sure everything runs. Effectively, a big company has bought a smaller bank at a throwaway price. With the shotgun marriage with the government saying, look, you buy this company, I'll make sure that the losses are minimal, I'll make sure I'll give you a window to recover this, I'll make sure I'm helping you out in all the background processes, and then do this. The last time this happened was 2008-9, and it was a super crucial move, absolutely essential, absolutely bunch of phenomenally tough financial maneuvers and political maneuvers that the US did. Probably backstopped the world and prevented it from going into a big depression. There was a 10% chance of that happening. So good set of moves, financially, economically, but rather ill-received politically. So by 2008, when everything was crashing, a compelling argument was made for saying, look, bail this out, put those two together, make sure that the financial system doesn't break, we'll live to fight another day. It's like an emergency thing. Somebody is coming in for a sudden cardiac arrest, you do everything to make sure that the body is fine. Bunch of things, every other problem you'll worry about later on. And that's what they did at breakneck speed. What happened after that? 2 years, 3 years later, all these buggers were back and functioning, and nobody went to jail. Nobody going to jail is a problem. It's a political problem. It's a big crisis which a bunch of these Wall Street buggers crossed, and nobody went to jail, which was politically a bad thing for the government that bailed out. So they said, look, you spent so much of taxpayer money and did all this. In the end, nobody was held culpable. So I think this time they're being super clear. From minute one, they've been clear that saying, look, no bailout will happen. Right? Now, when you talk about bailout, it is the technical understanding is, am I going to provide an exit for the equity holders? That's one thing. Second step is, what am I going to do with the deposit holder? And so suppose you take a bank in India, suppose you say Punjab National Bank. Punjab National Bank has a bunch of people who own Punjab National Bank shares, and has a lot more people who transact with Punjab National Bank. They have loans and depositors in Punjab National Bank. I can have a mechanism where the shareholders go to zero, but the depositors and those are protected. If I don't protect that, then I'm asking for bigger trouble. Gut feel, I think it's very likely to happen is that the Fed will step in and say, look, equity goes to zero, but depositors are all insured. So depositors are taken care of. Money, we put money in this bank, it will come to you. There'll be a freeze, there'll be a mechanism. They more or less said that you can have access only 50% of your funds today, but sooner or later they'll unwind it and give it to you. It's because the moment they say depositors are in trouble, then as a depositor holder, as somebody who's put money in, I start worrying about which banks are solvent, which banks are lending the right way. And I don't have a mechanism, the toolkit to handle that. That's a job of RBI or the American equivalent of that. Which means I'll say, look, I'll not invest anywhere. I'll put only in State Bank of India, the government national thing. I'll go find RBI. Whoever three people RBI says, I'll invest only with them. I'll put deposits only with them. Which means the entire tier 2 banking system will crash in 1 week, 2 weeks, 3 weeks, 2 months, whatever time. So they cannot afford for depositors to be killed and buried. So there'll be no bailout. They'll not say, look, I'm going to protect the investors or shareholders in Silicon Valley Bank or Silvergate or Signature or whatever it is. But the depositors will be protected. They will be taken care of in some form. They've more or less communicated that depositors are not going to be messed with because the systemic risk is too high. Right? What are the takeaways from this? Not just Silicon Valley Bank, probably quite a few others have indulged in this, which is money being printed and given for free. Right? So there's no risk management at all. They had tons of deposits, and they did not have to do a risk-weighed dispersal of funds. It didn't matter. It was a one-way thing to make money, get lots of deposits, buy treasury, keep booking profits, be happy. When it unwinds, that's when it causes trouble. Every time there is a book of deposits, there is a book of loans. If you're doing this, you have to keep an eye on that. If only one of this is happening, other is on autopilot, then you're asking for trouble. There's every chance that there are other banks that are in similar situation. There's every chance that some bond portfolio is being destroyed will cause equity buffer problems. Hopefully it's not super systemic and wide. I think the bigger banks are well hedged. The equity buffers are much higher. They should be able to contain it, but this is going to cause some trouble and some short-term pain. Finally, what is the India angle to this? And some of the Indian startup community has exposure to Silicon Valley. They bank with Silicon Valley Bank. It is easier to access the American customer base if you have your Silicon Valley Bank system being that part of the system. There will be some kind of deposit freeze for 3 days, some kind of withdrawal freeze for 3 days, broader withdrawal freeze for 2 months, 3 months. It's not going to be some kind of systemic risk for us. This is a problem of bank run for the American banking system. Larger, rather huge. Silicon Valley Bank, I think, is the top 20 American bank, which is significant. The American banks will have to, the government will have to reinstate trust and let the system going and not prevent any other bank run without stepping on politically wrong steps. They mentioned bailout, they did, and this happened once to the Barack Obama government. There was huge bailout, huge outcry, and then it became as if that the Barack Obama government had to some extent helped out or not really taken to task these Wall Street guys who had run amok. Something similar has happened. So the risk management, the system they had in place, the extent to which they were laissez-faire about balancing their duration in their portfolios. They were casual about having so much exposure that could be written down if interest rates went up. They did not evaluate banking risks like how banks should. And so those are all issues. There were a bunch of people who sold their stock in the 3 weeks prior to this happening, and quite a few of them are from these management and related entities in that. All those are issues, all those are concerns. So there's going to be quite a few investigations, recriminations, all of that is going to happen. And it is likely there are a few more banks who are in exactly the same problem. Lots of money has been pumped into the system. Lot of money that the government has printed and distributed has come back to the banking system as deposits. And because it is printed and distributed, given these funds and these VCs are pumping in money, loans have not been needed by people. So banks have lots of deposits, too few loans. They fill the gap with bond portfolio. That gets decimated, their equity buffer goes off. That could be a broader problem than anything else. And because of this, there are a bunch of other guys who have exposure to Silicon Valley Bank. There are guys who are the cryptocurrencies and exchanges. A couple of them have big. There's a stable coin that has a big deposit here. Those are all going to go through some amount of trouble. Is this a problem of bank run large institution in the US? Yes. Is this a fundamental problem for India? No. Our exposure to Silicon Valley Bank is not large. If there are founders who have the giant portion of their reserves in Silicon Valley Bank that they are not able to disburse salaries because of a 1 week freeze, then they're just talking nonsense. Then they're probably running their business the exact wrong way, worse than what Silicon Valley Bank was doing. So if some Indian startup comes and says, oh, we're having a problem because of Silicon Valley Bank, every likelihood they're just bullshitting and they have other problems and they're using Silicon Valley Bank as an excuse. And so Indian startup system has lots of other problems, and not with this. It's short-term liquidity problem because of Silicon Valley Bank. Of course it is a pain. Of course it is a pain. I'm not sitting and passing judgment on the pain that a founder might be worrying about saying salaries. But hey, you cannot say a chunk of my deposits are in only one bank, and if 50% of that is frozen for 3 weeks, I'll have to stop business. Then your buffers are too small and you're asking for trouble. And so I don't think Indian startup system, ecosystem is in that deep a trouble. And the US government has more or less hinted that at least 50% of the deposited money you will have access to as quickly as possible in weeks, if not days, not even weeks, days, probably in a couple of days. So I don't think it's a big liquidity problem. I don't think it's going to be an issue of depositors taking a giant haircut. I don't think those issues are there. It's going to be a 3-day, 4-day issue. At least I'm hoping that it will be only that. So I don't think it's a systemic problem for India. I don't think it's anything more than, oh my God, I'm not able to see my entire bank balance today and panicking because of that. I don't think there should be a year-long salary dispersal problem for Indian startups. I don't think those things are going to happen. But the American banking system, leaving out the top 6, top 7, has had a moment where there is every likelihood of this being present in 6 other banks, 7 other banks. And if it spreads and the linkages start flashing red, then they'll have to take more serious action. You have to sit and see whether that happens. But prima facie, I don't think India has a serious problem today. Right? Super guys, good, fun topic. I think I shouldn't say fun topic. It seems like I'm totally tone deaf. I'm talking about the topic of discussing banking and seeing what could be a problem because of this and that. I'm not saying I'm enjoying myself because Silicon Valley Bank is in trouble. I'm not that mean. But hey, good time to just revisit the idea of, hey, how do banks run? What are the banking fundamentals? Bank runs are very dicey things because it's a momentum thing. What is a liquidity problem can overnight become a solvency problem if it's systemic and 5 banks and there are serious people who are worrying about their funding. Hopefully it doesn't come to all that. Right? Good. Anyway, good talking to you guys. Best wishes for you.